Yeah, there are a few names. If you look at the major retailers in the U.S., the ones that import the most from China, whereas if you had tariffs on everything, not just the half of current imports that we have now, and it went to 25%, those are the ones at most risk. So far, that's not where we're going, but that's the thing we're going to be watching closely.
So the concern is if tariffs go to 25% across the board. Right now, we're just talking about $200 billion worth of goods, but the president's tweet on Sunday said this could go to the rest of them. That would wipe out earnings growth for the whole sector.
Exactly. So we're looking for retail earnings to grow just over 8% this year. If we got the 10% across everything, that would take about 3 percentage points off of that. And if we went to 25%, it would take away all earnings growth for retail.
Is this because their response will be to let their margins get squeezed?
Well, actually, this assumes there is some good mitigation in terms of cost reduction, moving sourcing. We've already seen this with some of the early tariffs to other countries, such as Vietnam or Bangladesh. But it's also a question of what you could price through. So we think the average retailer will be able to mitigate or price through about 80%. That's what we've seen so far of the first round of tariffs. So that's sort of our work assumes that could be kept up. If they couldn't do that, it would be more than just wiping out earnings growth. You could actually see earnings decline.
What is the calculus on the consumer and the consumer's willingness to take a price increase?
It's a great question. I think the good news is if we're going to enter a trade war, not that's ever a good thing, this is probably a reasonably good environment for the consumer. I mean, just the tax cuts last year gave us 50 or 60 billion. You could look at a 10% tariff on 500 billion of imports as basically the tax cut would go to
zero.
Fund the tariffs, right? Yeah. So the consumer's in a good spot with jobs growth, and so therefore, if you were going to do this, now might be the time to play deal or no deal.
One sector in particular on auto parts, we just last hour heard a guest say that he thinks auto parts are a place that could be affected dramatically by this, but you think they don't have much exposure, the likes of AutoZone and O'Reilly?
They do. If you look at AutoZone, O'Reilly, Advances are preferred in the space right now. Around 20% of their products will be imported from China, either directly or indirectly. What we think is key, and when you look at sectors that we think are better positioned, the ones with pricing power. So auto parts are already on the Section 301 list. We've actually seen 1 to 2% inflation in auto parts for the first time in a decade. So it does appear that the supply-demand balance in auto parts is pretty good, and that inflation is actually being priced through, and the market's taking it right now.
So Bed Bath, Best Buy, Target, those are the kinds of companies
that have more risk. The companies are either...
Do they not have the ability to absorb a price increase?
If you just do the static math, like they just import more from China. I think, if someone like Best Buy or Target's probably in a better position than Bed Bath to be able to mitigate it or pass it through. So again, we wouldn't pick a retail stock just on the tariff issue. But if this does escalate, those are going to be ones that people should be more concerned about.